the business will not make profit. What I'm saying is this: when we run the business, this is a school. This is a whole school. ISM has the Cambridge department. It has the Irish department. Yes or no?
Yeah.
They use electricity. Yes or no? But when you look at the way the school is being run, the Irish department has more students than the British department. Yes or no? So it is expected that the Irish department use more utilities.
Mr. The Irish use more
Utilities than the British department. So if the Irish department has to pay all the expenses alone, that means the British department might be making more profit than the Irish department. Yes or no? And if the British have to split this at the same amount, if they have to pay 50% on expenses, it means the British system or the British department will be cheated. They will be making a loss. So what do? We have to apportion it according to the usage. So we split it based on how we use them. So we can count, the British department has 10 classes. Let's say, the cost of electricity is, let's say it's 1,000 euros. The British department has 10 classes. The Irish department has 15 classes. Assumption. And the cost of is 1,000. The cost of electricity is 1,000.
per class.
No, the total cost of electricity is 1,000 euros for 25 classes now.
Okay.
These are 25 classes, right?
Mr. Can you please open the website?
Okay. For apportionment, we want to split based on usage. So we assume that in this school, we have 10 classes for the British department, we have 15 classes for the Irish department. The cost of electricity is 1,000 euros. So that means we have 25 classes. We can apportion it into 1,000.
So the British department pays for 10 classes and the Irish department?
Yes, that is apportionment. So we can do it this way. 1,000 divided by 25 to know for each class.
What?
1,000 divided by 25 classes.
Like this was the British will lose.
No.
Because
How are we going to make loss? This is the cost of, this is the cost of electricity, which is an expenses
all classes.
for all the classes.
Yes.
But we need to apportion to the British department and the Irish department. But they are not using the same electricity.
What's a portion?
Apportion means we are dividing, we're splitting.
Mr. Why don't we divide 1,000 by 10 classes? And like this we will see the expense of British classes.
No, we already have the figure, which is 1,000 euros. But it is easier here because we have 25 classes. Yes or no? Just listen and look at this. We have 25 classes, and the total electricity is 1,000 euros. This is apportionment. We have divided the classes into this: the British department, the Irish department. So to know how much electricity is being used by each class, we have to divide by what? 25.
40 for each class.
40. So it means 40 multiplied by 10, 400. 40 multiplied by 15, 600.
Yes.
So the Irish department will be apportioned with 600 of electricity bills and 400 for the British. This is, yes? Do you get it now?
Yes.
You don't get it?
How do you get 600?
1,000 divided by 25 is 40.
Okay.
40 times 10, 400. 40 times 15, 600. Doing it this way, it means we have given each department what they have used in terms of expenses. So no department is being cheated here. So when we do this, we have apportioned the expenses. Is apportionment clear here now?
Yes.
Any question?
No.
Do I answer your question about apportionment now? So now let's look at this. Apportionment of expenses. In some cases, expenses have to be divided into different categories within the business. Different categories within the business. British department, Irish department are all ISM. Yes or no?
Yes.
But we have divided them into what? Two. Based on the expenses. That is what we did. I think it's clear.
Yeah.
Great. So, here I wrote. Different categories. We have business expenses. For business expenses, we're talking about expenses of the business. But you have to remember that in accounting concept, there's what we call business entity. Business entity. which means the business is different from the owner of the business. Yes or no?
Right. Expenses different.
Why?
No, because it's with the owner. Maybe you have a company for insurance. Okay. So the owner takes the equipment of the company.
Oh, sorry.
Okay. I'm with you. Is that no? Is that why?
No, maybe the owner makes insurance for his own. So that's called drawings.
Why do we get to drawing? That's the point. The point, my question is, do we understand what business entity is? What is business entity?
Business different from the owner, though.
The owner of the business. That means you treat the business separately from the owner. It is an accounting concept.
Why?
I'm coming. Accounting concept. We use it for the private, for limited companies. So there is this concept that says the business should be treated separately from the owner of the business for limited liability companies. So as soon as the owner of the business puts money into the business, that is why we call it what? Capital.
Why do you treat it different than
They are treating them differently because they are limited companies. Limited simply means the debt does not go further than the business. The debt of the business is within the business. It's different from unlimited liability, like a sole trader. A sole trader, the business is treated the same way as the owner. Partnership, the same. Sole trader, partnership, they are unlimited. Unlimited liability. Which means whatever happens to the business can affect the owner of the business. The small shops in your area, the supermarkets in your area, the small shops, the small shops, the owners are sole traders. So whatever happens to that business affects them. That is unlimited. But here we're talking about limited, which means whatever happens to the business ends with the business. As soon as the business owes a debt, a creditor, they won't use your car to pay back because the business is separated from you. Do we get what I'm saying here? So there's business entity, which simply means accounts should be treated separately from the owners. So you don't put them together. What happens to the business stays with the business. What happens with the owner? The private life of the owner is private. The business is business. So how do we know within the business? That's why when the owner of a business puts money into the business, we call it what? Capital. And as soon as the owner of the business, sometimes it's your business, yes. You might take money from the business, isn't it? So taking money from the business means you are what? Destroying it. You won't treat it as expenses, no.
It's when you take money out of the business.
Yes, draw it. As the owner of the business. When the owner of the business puts money into the business, it's what? Capital. So the way you have treated the owner, yes? You're saying something? Capital is the amount of money invested into a business, the amount of money you start with a business with. So as the owner of a business, as soon as you put money into that business, it is expected that the business pays you back. The business is owing you. The business is indebted to you. Put your head up, please. Head up, please. Yes. The money that you put into the business, it is expected that you get it back. The business is owing you. It's your business, but the business is owing you. That is business entity. So whenever you take money from the business, it means you are owing the business. Drawings. So that's why, as soon as the business makes profits, you must less drawings. So if the business makes profits now, whatever the owner of the business has taken from the business, you have to take it away from the profits. Because the business is different from the owner. Yes, please. Okay. Do we get it or not, please?
They're different from each other. So
Yes.
like they're not connected to something like this.
They are connected. The business, it's your business.
Yes.
But whatever happens, you have to be treated separately from the business.
Why?
Entity.
What does entity mean?
Entity means you are you. The business, it's it. It is an accounting concept. The way you have to run accounts. We don't just listen. Accounting is not just what we do. Account comes with regulations, rules. It's not just you're waking up today and you start running. No. Accounting have concepts and conventions, how it should be done. That is why there's what we call International Accounting Standard, IAS. Account in Libya is the same as account in Nigeria, is the same as account in Russia, Ireland, wherever. The same account is the same account. That's why we call it what? International Accounting Standard. You don't just wake up and start. No. Account has concepts, how to prepare them. Not for you, not for me, it is how it has to be done. It's account. Do you get it? So whatever happens to your business, let it stay with your business. Whatever happens to you, let it stay with you. So that situation is called business entity.
What do you mean by me?
As an owner of the business.
If you get bankrupt, who will pay the business?
If the business gets bankrupt, bankrupt is not something you say. Bankrupt is a declaration. It's a declaration. But they don't just say, oh, I got into bankrupt. No. Because when the institution comes, it means you need help. You need help. So before a business is considered, before a business declares bankrupt, it would have been shown, it would have been confirmed that the business is bankrupt. Because as soon as you are bankrupt, it means you become insolvent. Insolvent. You don't have money anymore. So you need help. You have gone into administration. At this time, yes.
So for example, when the company goes bankrupt, right?
Yes.
You don't just go broke right away, right?
No. Because you have assets.
Yeah.
So the first thing they do is they liquidate your assets.
What?
Asset. They liquidate it. They sell your property. They value your property. They value whatever you have as a company.
When a company goes bankrupt, can I sell it to someone else?
No.
You don't. When the company goes bankrupt, it is off your hand. You don't decide what happens anymore. It will be decided by the administrators.
I'm the owner, so I should be the
No! You said you cannot hold it anymore. You said it. Or when you say you are bankrupt, it means you can no longer operate it. You said it. You need help.
Yeah.
And they have to help you.
Who are the administrators?
Administrators. These are people that manage businesses that are bankrupt.
Ah, good.
Do you get it?
Yes.
Listen, when you declare yourself bankrupt,
Yeah.
it means you can no longer fund the business.
So you look for investors.
No investors this time. Who will invest in a business that is going down? No. You need help.
Why would the company go bankrupt in the first place?
There are different things. Poor management. That's poor decision making. Too much of credit.
What do you mean credit?
You take a lot of loans.
Ah.
Lack of cash flow.
Decision making.
Yeah, I talked about that. Lack of cash flow. Money is not coming in, going out. You cannot manage your cash. Demotivated employees. Workers that you have, they are not happy working with you. That would reduce your productivity. Then there are external factors beyond your own control.
When I explained demotivated employees.
Do you understand now?
Yes.
So this is not where we're going anyway. Where we're going is apportionment, which simply means
You split it.
we split expenses according to how they are being used. So we have the business expense, which is now, because the business is different from the owner of the business, whatever expenses the business has goes to the profit and loss account. Whatever expenses the business has goes where? The profit and loss account as expenses. Whatever the owner of the business takes from the business, can you stop this already? Hello? It's a classroom, right? You focus here, that's all. I don't want anything from you now to focus. Please note this. Whenever the business have expenses, it goes to the profit and loss account. But when the owner of the business takes money or has expenses with the business, it goes to where the balance sheet as drawings. They are both expenses, but they are treated differently. They are both what? Expenses, but they are treated differently. Business expense, profit and loss account. Private expense has the owner's expenses in the balance sheet. Clear, right? You take this away from the profits. You take this also away from the profit. But the profit you're going to take this from is from the balance sheet. The profit here is the net profit. Clear, right? Is it clear, please?
Yeah.
Then we have carriage inward. Why do we call it carriage inward? Here. You better be here. Look, if you are here, it is better for you to make it worth it. It's not a waste of time being here. Don't waste your time if you know you want to be here. There's carriage inward, which simply means we are paying a certain amount of money to bring the product into our premises. This is what we sell. The amount of money we use to bring them to the office before selling is carriage inward. You take it away from your trading account. It's part of your trading account. It's part of your cost of production. Carriage inward. Then there's carriage outward, which is the amount of money you spend to convey the product to your customers. The amount of money you use in buying the product, the amount of money you use in transporting the product from the supplier to your business, carriage inward. It is part of your cost of production. The product will be sold to your customers. The amount you spend in transporting the product from your business to the customers, carriage outward, expenses. This is cost of production, this is expenses. You take this away from your trading account, you take this away from your profit and loss account. They are both carriage, but one is in, the other is out. In is part of your cost of production, out is part of your expenses. Do we understand this point? Then we have the question here.
There's only 2 minutes left.
It's enough for me to do it.
Mr. Can you give us time to revise the...
Stop that already. Let me just finish what I have to finish here, please. Light and heat is 5,000. Additional information is estimated to be 20% of light, and heat should be recorded as private. So the 5,000 is the total expenses on the light. So we have light and heat for 5,000. But 20% of it, 20%, 0,000. That's 1,000, right? 1,000 goes to your balance sheet.
100.
Is it 100? No.
Oh, yes,
1,000 euros goes to your balance sheet as joint. Then 5,000 minus 1,000, that's 4,000, goes to your profit and loss account. So this is your PL and this is your drawing. This is drawings, and this is your expenses. Is it clear?
Yes.
No. No, it's okay. You can tell me yes.